Hello, class. Welcome to the Chapter 3 Handout 1 answer video. I'm going to share my screen. We're going to get started here. For this, you're going to need a couple of Word documents. You're going to need your Handout 3 for Chapter 3 Handout 1. This is what we're going to be doing. And you're also going to want to have your general journal available. It's going to ask you to journal a lot in this one. So let's just start off here. So this first one, we do not need to make any journal entries. We're just trying to give you a conceptual idea of what kind of maybe adjusting entries might we have to make. Remember, adjusting entries are made in order to fulfill the revenue recognition and the expense recognition principles to get revenue and expenses into the right time period. This is done by making an adjusting entry, which always affects one revenue or expense account and then one balance sheet account. Okay, so Singleton Incorporated uses accrual accounting and have the following transactions. Do they require adjusting the trade? Why? Sold merchandise to customers on credit. Well, here the only way that's going to require an adjusting entry is if they have not recorded it yet. So that could be an accrued revenue where they would need to record the revenue and create an accounts receivable. Okay. So that would be the only way that would require an adjusting entry. Purchase equipment to be used in the business. This is going to require a depreciation adjusting entry. When we purchase the equipment, we would have debited the equipment and credited cash if we paid cash for it. And then depreciation is the process of expensing the cost of that asset over its useful life that we need to do each accounting period. A 2-year insurance contract was purchased. When we purchased that, yes, we have cash going out and we get another asset called prepaid insurance, which we would need to make an adjusting entry for to recognize insurance expense as the months passed by and then insurance policy got used up. Receive cash for services to be performed within the next year. Yes, this would be a deferred revenue situation. So when we receive the cash, we record the cash as a debit and create a liability of unearned revenue because we have not performed any of the services. And then as we perform those services, we would need to make adjusting entries in to move it out of unearned revenue into service revenue. Paid weekly employee salaries. When we come to pay them, we really do not need an adjusting entry. We might have to take an adjusting entry off the books. If we were paying them on Friday and the reporting period ended on Tuesday, then we might have a salaries payable on our books because they had to record that expense there when the period ended and created the payable with it. But actually, when we pay them, we're never going to be making an adjustment on the day that we pay them, maybe just removing an adjustment. And borrowed money from First Bank by signing a note payable due in 5 years. So here we're going to have an interest expense. If we borrowed money, sign a note payable, we would receive cash, create the liability of note payable. And then every reporting period, we'd have to record how much interest had been accrued up until that point in time. Okay, we probably wouldn't pay it back till we go back to pay the note back at the end of the 5 years. So we'd have an interest expense and an interest payable. Okay. Just kind of thinking through those. Do we have any accrued revenues, any accrued expenses? Where do they come from? Did something happen that we're going to pay for now, or did we already get some cash and we got to do something later? Those are what we're looking for there with the accruals and referrals. When we move on to number 2 here, I'm going to take this sheet away, but I'm going to put up the journal sheet. So hopefully you have your handout available. Draw with a touch here. So it says we provide janitorial services that are the following transactions in April. So on April 1st, we received $24,000 for services to be performed over the next 6 months. So we received money, we received cash. Our cash is an asset. Normal debit balance, we will increase our cash to $24,000. This is services to be performed over the next 6 months. We have not done any services yet. So instead of revenue, we have unearned service revenue, which is a liability. We will record for that amount. At the end of the question, it says, think about the entries I do in the future. Okay, so if we got to the end of April, 4/30, and they had used up or they had performed $4,000 worth of services. So on this date, we can remove it out of unearned revenue by debiting to a liability. And now it has been earned. We can move it into service revenue. The amount of 4,000. And if we were looking at our T accounts here, you can see for our unearned revenue, we had 24,000 that went over there. We took 4,000 off. We still have $20,000 credit balance in our unearned revenue, and that still has to be performed. Okay, so there's how you initially record some unearned service revenue and how you would record it as it got used up. Okay, that was number one or number two. Number three. Actually, 2A. In 2B, we're on April 5th. We purchased and received $8,500 worth of supplies on Eagle Supply Company. So on this date, we just purchased supplies. So we are going to increase our asset of supplies. It says it was on credit, so that means we're going to pay them later. So that means we have an accounts payable, a liability, something we owe. And we just recorded it at the month. Or at the amount that we've actually bought, 8,500. What entries would have to be made in the future? Well, when we pay for these supplies, we would debit our accounts payable to make it go away, and we'd have to credit cash because cash would be going down. But we're not worried about that entry. We're going to say on 4/30 though, we're preparing our quarterly reports here. We had $1,300 worth of supplies were used. And it's important to read how the wording is here. Here it says it was used, not left. Okay, so we know that 1,300 was used. What is used becomes our supplies expense. We use 1,300. What we do is we take that out of supplies because if we use them, they are no longer there. So we would credit our supplies account in order to make that go down. Okay. So we see on April 20th, we performed a one-time cleaning for Jones Company. They paid the bill on May 10th. Okay, so here we performed a service. So we get service revenue, which is always a normal credit balance. So I'm going to put it first, but I know it's going to go second. Service revenue, 2,500. Here they did not pay us on this date. We put it on there because that's the date that we did it, so we can recognize it. And since they didn't pay us, we have an accounts receivable because now they owe us some money. On May 10th, when they were to pay us, now our cash goes up by 2,500. And we can credit here our accounts receivable. We can make it go down because they no longer owe us. And notice that we received the cash on May 10th, and we did not put anything into revenue. All of the revenue went in on the date that the service was actually performed. Now for 2D, on April 30th, we paid wages of 3,400. An additional 850 was still owed to employees for work done in April. Okay. Here, I know we're going to have a wage expense because there was some work done in April that we need to pay for. Although we do not know that amount yet, because it says we paid wages of 3,400. So the cash that went out was $3,400. We're going to assume that since the cash went out, they had earned that. Okay. Hopefully the microphone working now. Good. Okay, so it creates a liability. We will call that wages payable. And it was, they said 850. So our wage expense then is those two added together. How much we paid plus how much we still owe, because all of that work was done in April. So to follow that expense recognition, we have to wage expense it as a debit entry at the end of the month to have it into the right reporting period. I don't want that. Let's just close it. Now let's open it again. Because I want it to be clean. Okay, so now we're getting into number 3. This journal and think about what the effect on the financial statement fees were omitted. So 3, manufacturing company had the following items that require adjustment at year end. So we're just going to say these are all 12/31 adjustments, year end. Salaries were earned in December, but not recorded or paid. So if they earned it in December, we need to make an expense for that expense recognition. Salaries, so we will debit a salaries expense for 5,320. Had not been recorded, not been paid. We owe them that in the future. So we will call that a payable. In this case, we'll call it salaries. Salaries payable, which is that current liability because it will be paid off within the next year. For 3B, put another date in there because we're starting a new entry. Use 1,970 utilities that was not recorded or paid. In here, if we used it, that's that expense recognition principle. So we need to do utilities expense, not recorded or paid. So we're going to pay it later. Then creates that current liability. We will call it utilities payable. And the amount here, 1,970. And finally, for C, interest of $912 $2,500 note that was not recorded or paid. So here we going to pay off probably the interest whenever we pay the note back. We did have some interest expense here with it. So we need to record that interest expense to get it in the right period. But again, it's going to be paid later. So we create an interest payable or another current liability for that amount of $925. Okay, so these were omitted. If any of these were omitted, what effect is it going to have on our financial statements? Well, it's going to affect our expenses if we leave any of those out, right? It's going to mean our expenses will be lower, which will make our net income higher. We will overstate our income. We will understate the expenses. And also, if we're looking at the other statement, the balance sheet, all of these create a current liability. So if we left them out, our current liabilities are not going to be as high as they should be. They will be understated. Okay. And remember, expense goes into that retained earnings. So then we will be overstating our amount of owner's capital as well. All right, so 4. Here we have some we have a company that collected 2 contracts. Okay, so company A, we collected $4,250 in advance on contract. The cash was credited to unearned service revenue upon receipt. Okay, so that means when it firstly happened, give us date, so we'll call it upon receipt. The company's cash increased from $14,250 but they also had unearned revenue, $14,250, because it was all received in advance. None of the work had been performed yet. And it says 1,210 remained unearned at the end of the year. Okay, so here we have to look at our T account. We have unearned revenue. We put 14,250 in there. It is telling us that how much 1,210 remained at the end of the year. So we know how much they paid us. We know that this is how much they, according to our services, that's how much of the work still has to be done. Okay. We need to make a journal entry in order to make this T account balance by putting a number over here on this side. So we took the 14,250 and subtracted 1210 out of it. We would see that we would need to make a debit kind of entry of 13,040 in order to make that true. So at the end of the month, when we go to recognize this revenue, we have unearned revenue at the amount we just calculated. And now that becomes service revenue because this amount of work has actually been performed. That is what we've done. We knew how much work we had to do at the beginning. We knew how much work was left to be done. So we can say the rest of it got done. B looks at one a little bit differently. Here we collected $9,480 in advance on the contract. So upon receipt, we would have cash and unearned revenue. I believe it said it was 9,800. If it's not, I'll change it. Oh, 9,480. $94.80. Then it says 3,280 services were provided before year end. So when we go to recognize our revenue, we're gonna do the amount that was actually done, and here it gives us that amount. There is no calculation like there was in A where it gave us the ending balance. It tells us that these services were provided. So in this case, if you take off unearned revenue, and now that the services have been provided, we can call it service revenue. And the amount that was actually done of 3,280. Now it says, then calculate the ending unearned revenue balance for each contract. So for contract A, it is right here. Right, it gave us the ending balance of 1210. The journal entry we had to make was in order to make that accurate. But for number A, the unearned revenue, or for B, it started at 94.80, and then we did 3,280 of the work. Meaning that we had a balance still of $6,200 worth of work that is still remaining to be done on that contract. Number 5 on our back side here. Is journal, the thing about the financial, have these not been made? Still wants to know some ending balances, okay. Says paid 3,800 cash in advance, which was debited to prepaid rent. Okay. We're gonna say at the beginning of the year, we paid out cash 3,800. Okay, we are paying for rent. We have not actually used this building at all yet. It is an expense, and we're paying in advance. Okay, so it is a deferred expense. Here we will create the asset, prepaid rent, okay, in cash. And then it says at the end of the year, somehow we paid too much because not all of it had expired. 2,950 of the rent had expired, meaning we had used it now. It had been incurred. So now we will call what we actually used or what expired rent expense. Because it has been used up now. 2,950. But we didn't have to pay any cash, and we don't owe any money. So we don't want to lower cash. We don't want to create a payable. We want to lower the asset that we created when we actually paid the cash prepaid rent. And if it wants to know the ending balance, 3,800, take off 2,950. Meaning there was still an $850 balance in there of rent that still needs to be used up. For B, $711. Now we have the same thing here. We paid for some insurance of $8,200. On the day we paid for it, it has not been used up yet. We're going to use it as time elapses, so it becomes a prepaid expense, prepaid insurance. At the end of the year, the same $1,850 is still unused. So the end of the year, we have used some of it, so now we have an insurance expense. Just like with our rent, our prepaid insurance is going to go down. What do we want to record here? We want to record what was used. The number it's giving us, it says it was still unused. So we need to do a little T account analysis for our prepaid insurance and see that we started with 8,200. At the end of the year, we still had 1,850 that was still unused. So how much did we have to use in order to make that a true statement in our T account analysis? We need to put 6,350 onto the credit side in order to make our T account analysis balance out there. It's not telling us how much we use, it's telling us how much we had remaining. And so be careful with these questions like this. We've got to do some thinking. But this is the journal entry we would pop in here that our insurance expense would be 6,350 for the month. We'll be lowering our insurance by 6,350, giving us the correct ending balance that it was asking for. All right, so now we have C, supplies. Show the beginning balance of 2,000 during the year. Best purchase an additional 16,200. A year-end count total 4125. So we're doing a year-end count here. So years passed. We're dealing with supplies. We are going to have a supply expense because we've used some up now. And we always need to offset that by crediting our assets supplies by lowering the amount of supplies that we have. So for C here, we take our beginning, which was 2,000, plus our purchases of 16,200, meaning we had 18,200 in supplies available. Subtract out what we counted at the end that we know we still have. So if we had 18,200 available and we only have 4,125 left at year end, means we had to use 14,075. And that's what we were recording as an expense, how much we actually used. This is the same thing as the other ones. If we were to omit these, we would be leaving out expenses. Okay, meaning our income would be higher than it should be. And we, in this case, our assets then would be overstated. You'd be saying we have more prepaid rent than we have. We have more supplies than we actually have. Okay, it will look like we have a bunch of assets and less expenses. Finally, the Gardy company has a machine that it purchased for $125,000 on January 1st. Estimated depreciation for the machine is estimated to be $14,500. So if we were going to journal this, number 6. We have depreciation expense. In our contra account, accumulated depreciation in the amount of $14,500. And that is something that would have to be done at every year end. That same entry would be made. Okay. Then it says in machine, what is its book value? Well, in year 1, the cost was $125,000. You subtract out your accumulated depreciation, which in year one, it was just 14,500. Which means our book value then is 110,500. For year two, we would take out another 14,500 here. And you can see that our book value then becomes 95,000. We just keep taking the accumulated depreciation away from that. Okay, so there's how you make some adjusting entries. Hopefully that, plus the examples that he gave in the slides, you can have in the book, make you be able to get through that part of the homework questions. Now you're ready to move on to the chapter 3, lecture video 2, where we will talk about some closing entries and then do handout 2. And that'll be it for the videos for this chapter. I'll talk to you again soon.